current assets. So current assets, current liabilities, this is 1 year. 1 year is your key phrase here, your super important concept. If you have an asset that can be converted into cash in 1 year or less, it's going to be a current asset. So cash, cash equivalents, inventory that's going to be sold within 1 year. Whereas if you've got buildings, you've got land, those are fixed assets. Those are long-term assets, not going to be current. On the balance sheet, current assets are presented in order of liquidity. Now that's important because we go back and let's look here. Well, cash is the most liquid, right? I can immediately do anything I want with my cash. However, inventory, that's a lot less liquid. I need to sell that. Maybe accounts receivable, it's a little more liquid. Trading securities, even a little bit more liquid. So this is an order of liquidity of most liquid to least liquid. And this is going to be our most common format for the balance sheet, right? Even PP&E. Land is pretty liquid because it doesn't have anything on it, presumably. It's just a plot of land. Whereas a building, okay, a little less liquid because maybe someone wants to start a farm in there and they don't want to necessarily have your building on it. And then equipment is even less liquid because it's possibly specialized for something. And that's the case for all of our accounts here. Good logic to follow. Some accounts, such as cash, can be presented at face value, right? I mean, that a dollar is a dollar. Others have different treatments. Short-term investments are displayed at fair value. So yeah, if you're holding stocks in a company, it makes sense to report at fair value because that information is pretty easy to obtain. Whereas maybe revaluing your plot of land every year, maybe that's not as reasonable. So that's why that's going to be at historical cost. Accounts receivable are reported at net realizable value. Now, like I mentioned, this is, and we'll go into this more in the AR section, this is subtracted out allowance for doubtful accounts. So if you think you're only going to get 95% of your accounts receivable because in the past your customers only ever paid you 95% of what they owed you, that's the net realizable value. So you're owed $100,000, but in the past they've only given you 95%. So you're going to say accounts receivable is 100, allowance for doubtful is 5, so 100 minus 5 is $95,000 net receivable. Long-term investments, these are also on the balance sheet that we saw. And yeah, these are just investments, different types of investments. We got stocks and bonds, investments in subsidiaries, affiliated companies, fixed assets, lots of different types of investments.